So, in today's Cheeky Trading. In my last video, I talked about the basics of TradingView, which is a software that I use to analyze the market. I also went through the principles of technical analysis and talked about supports, resistances, and trend lines. In my last video, I told you how to spot them by using TradingView, but in this video I'll go a little bit deeper and I'm gonna show you how you can actually trade using these lines. I'm also gonna talk about a very important indicator, which is the volume, and why you should always take it in consideration when trading. So if you're curious about it, just chill and keep watching. Hello everyone, how's it going? Welcome back to my channel, and this is your host, the Cheeky Entrepreneur. So in my last video, I talked about how you can actually spot resistances, supports, and also trend lines. This video I want to focus a little bit deeper on how you can actually trade them in order to profit. I'm also going to talk about this volume indicator because it's very important. And I'm gonna use gold as an example because in my opinion gold has a very good technical analysis, a very good movement by using TA, and I really like it and I would still trade it, but I'm focusing more on cryptocurrencies, as you know right now. But anyways, if you want this volume indicator, the only thing that you need to do is actually go to these bottom indicators and you're gonna write volume, and the first one, which is the built-in, is basically the one that you're gonna want to have. So after doing that, the next thing that I recommend you to do is to go and format it and go through volume MA. This is basically a line of the moving average of the volume. And you want to have this because it's very important to know when the price has above average volume or below average volume. And I'm gonna tell you why that is so important while trading. So if we do kind of like a little recap over here, for instance, if we wanted to assess this ranging market, we know that here we got a resistance around that level, and we also can see that we have a support more or less at this level. And again, TA is not perfect, it's not like a hard science, you know, it's more about the interpretation that you get and also how you go along with the market. But in any case, we know that we have points of contact. For instance, here we have a 1, here we have another 2, 3, we have a kind of like a fake out over here, and we got various points of contacts where the price has actually retraced back. So now that you know about these ranges, you have to take a look at the volume. And something that I like about gold is that the volume is very predictable. You can actually see it, and there's moments that the volume spikes a lot and there's moments that the volume just goes off. And the reason is because whenever you're having let's say a price movement to the upside, you want that be accompanied by volume. And the reason is because, again, this is all about supply and demand. If there is demand, you're gonna have buyers going in and creating this volume as supporting the price. But if there is no demand, of course you're not gonna have buyers, so the volume will decrease, and then that's where the supply comes in. There's an excess of supply, thus the price goes down. So if we just look, for instance, at how the price is moving around here, whenever we see that the price is actually going down, we can see that there is a lack of volume. I'm gonna try to illustrate this right now. So for instance, here, if you see, here's where there's almost no volume at all. So if we go and see that the volume starts picking up, if you see around here, it starts kind of like going up. And what happens with the price is that it starts going up. And that's a very good indicator that the price might continue going up because there's volume backing it up. But then let's take a look at what happens next. For instance, if we continue, then we see that there's this kind of small push around here to the upside. But when we look at the volume, there's no volume at all. There's almost like a gap over there. And this is very important because that tells you that there is not enough buyers, there's not enough demand at this point. Thus the price starts falling off. And this is very important because you have to recognize the volume, because volume is one of the most important indicators because it's a very raw indicator. It does not involve like a very complicated formulas, and it tells you what's happening at the real time. But in any case, if we look again, for instance, another example, around here where the price started increasing, we had again a gap where there was no volume at all, but then the volume started picking up around here, and what happened, the price started picking up. One of the reasons that I'm doing these videos is because I want to give you the example so that you can do it once and then you can repeat it, because the more you do it, the more you're gonna familiarize with the market. So again, in here we see that the price actually fails to go up, and this is the spot where I would say, okay, you gotta short it, because again the price starts going up around here, but the volume is the volume is lacking in here, and this is a very good indicator that probably the price is not gonna actually go up. So in here it would be a good opportunity to actually short, and if you would have done that, you could have gotten more or less 1%, let's say. But if you do it with leverage, then you could have gotten even more than that. And I'll talk about leverage trading in another video, because it's not something that I enforce, it's not something that you should do, but it's a very useful tool in order to profit even more. But of course, it's always about the risk reward. So the more reward you get, the more risk you're gonna have to put in. So there's three main ways which the price can actually move. So you have horizontal or sideways movement, for instance here, which is in a range and it's kind of horizontal. You can also have to the upside, which is an uptrend, or to the downside, which is a downtrend. I prefer to trade with uptrends and downtrends, and the reason is because it's a little bit easier not only to analyze but to trade them. But in any case, I'm gonna show you how you can trade in here. So there's basically two ways of trading this. You can either trade the ranging market, or you can trade the breakout. And again, a lot of people like to trade the breakouts, a lot of people like ranging markets. It really depends on what you prefer. Both can be really profitable, and I think it's probably trading the breakouts is gonna be easier for you to spot, and it's gonna be more profitable in the long run, and it's gonna involve less risk. But again, here with my videos, I don't want to teach you one way to do it. I want to give you the tools, I want to give you my opinion so that you can actually learn on your own. So for instance, we have right now this ranging market. So now that you know that volume supports the price going up, and if there's lack of volume, the price is gonna go down, we can actually analyze some trades around here. So let's say that we look at the price over this period of time. So from now on, we say, okay, we want to trade this ranging market. So whenever we go to the resistance or support line over here, we're gonna try to analyze the volume, we're gonna try to analyze what's going on with the price. So for instance, in here, one thing that I said is that the price actually started moving up around here, but if we look at the volume, there's none. So that's a very good indicative that the price is gonna actually fall. So you could have traded that in here. Let's see, and in here the price didn't actually reach the support, and therefore here if you wanted to trade, you would still have this going against you, or possibly going against you. But let's go at the next scenario. So for instance, here we start analyzing. Okay, we see that the price actually went kind of broke out to the upside in here, but we're gonna analyze this movement now to the upside. If we go through the volume, we can see that there is lack of volume around here. There is not volume accompanying the price going up, so this was very likely to fail. So you could have shorted in this line, or you could have shorted if the price broke out and you see that there is no volume. So right now I want to analyze this breakout. For instance, here it's same scenario, it's always the same principle, and again I just want to do a lot of examples in this video because that's the best way that you can learn. Here we saw that the price tried to move up in here, but again there was lack of volume around here, so we knew that the price was not actually gonna go up as previously it has done when it's accompanied by volume. Now you want to see if the price is actually breaking down or breaking up. you have to look at the volume. For instance, here we see this huge red candle over here, and we see that there's a lot of selling volume. So in here you would assume that this is already broke out. So for instance, if you were here and you already noticed that there's no buying volume, here you could have either shorted, or you could have put a pending order after here at this level. But in any case, let's say that if you wanted to trade this breakout, you could have put a pending order to actually sell around here. But here, another way to trade is, for instance, the price might actually go up, and as I told you in the last video, resistance are supports and supports are resistances. So this support could become a resistance, and then if the price actually goes up, to test it, it could go back down and establish a downtrend. In any case, I want to stop talking about these horizontal movements, because in my opinion, that's not where most of the money is, or where the best opportunities are. So for instance, in my particular opinion, the best movements are when the price is actually going up or going down. So in the last video, I told you how to actually start spotting these prices. For instance, over here, we see that the price actually touched this twice around here, a third time over here, and then here we start seeing that there was kind of like movement to the downside as well. So one of the things, that the best way that you can actually trade this is to trade the breakouts to the other side, and again you would use volume for that. So if we see over here, there was lack of volume around here, but when the price started going up, the volume started peaking, and that's the indicator that the price is gonna actually reverse, and that could have been a very good entry around this specific area. And again, it's all about the breakout, and it's all about the volume. And the same is for the other side. For instance, if we would have waited for the price to actually do something, we could have said that this was kind of another uptrend. And in here, same principle, we see that the price is actually going up. In here, volume is dying. Around here, the volume is dying, and there's a lack of volume. And again, if there's lack of volume, there's more supply, because there's not enough demand, and again the price went down. And this is actually, in my opinion, the best way to trade, and it's very straightforward. So in the same fashion as you can trade the range, or you can actually trade the breakouts, you can also do this with channels. So for instance, let's say that we have already seen this kind of a downtrend over here. So if you want to create a channel, you can grab the same line and actually put it around here over these prices. Something that I like is that, for instance, another way to possibly trade, but again you have to look at the risk reward, this is more risky. For instance, whenever you have these channels, then you have kind of these oversold or overbought positions. For instance, if this is a downtrend, you have this overbought position in here, so you could actually have bought around here, wait for the price to go here, see if the price breaks out. If it breaks out, you leave the trade and possibly continue going up, but if it starts turning on, then you just take profit. And that's another way that I like to trade. And again, it depends on my mood, it depends on how the market is behaving, and what the risk reward I want. But that's another way to actually do it. And for instance, here, if it's a downtrend, you can do the opposite. Whenever it comes around here, you can actually sell in here, and you can put a stop loss, for instance, around here, in case that if the price breaks out, you're gonna be protected. But you see that the price continues going down. And of course, something that I'm gonna say right now is that it really depends on other indicators that you use. Right now we're using the pure price action, but there's other indicators that will help you, giving you enough information to actually say whether it's good to actually short it, or whether it's good to actually buy. But for instance, just like the first time, let's see around here. Let's check the volume, and again, so when we see that the price is actually going up around in this area, we see that there's a lot of volume going up. So here it would have been a good idea to actually have long when this breakout happened. But the point is that whenever you're trading and you trade these breakouts, you watch the volume and see what the price is actually doing. Well, anyways guys, I hope that you learned something and you enjoyed the video. And if you did, and only if you did, mind subscribing, maybe also like the video. You know that you can also find me on other social media. I got an Instagram account where I post all the highlights of my videos, as well as some posts on entrepreneurship. If you want to support the channel, you can check the links down in the description as well. But anyways, just before I go, I would like to remind you all, stay smart, stay bold, but most important of all, stay cheeky. Take care.